On August 15, 1971, the US dollar stopped being backed by gold. What led to this historic moment, and why does it still affect your money today? Let's uncover the rise and fall of America's gold standard.
In the beginning, there was no American banking system at all, only a set of scattered colonies trying to trade, build, and survive with a chronic shortage of money. The story of early American banking is really a story about how a new society learned to turn promises into purchasing power, and how those financial tools, sometimes clever, sometimes reckless, helped transform small coastal settlements into a growing nation. In the 1600s and early 1700s, the English colonies lived with a constant lack of hard currency, meaning gold and silver coins, often called specie. Britain's mercantilist system encouraged colonies to ship out raw materials and buy finished goods from Britain, which tended to pull specie back to the mother country. Trade deficits drained coin from colonial ports, and what money remained was often clipped, worn, or foreign. As a result, colonists relied on barter, commodity money like tobacco or wheat, personal IOUs, and book credit recorded by merchants. If you were a farmer, you might pay a storekeeper after harvest. If you were a merchant, you might extend credit for months. This credit economy worked until trust broke down, crops failed, or prices swung. Because day-to-day commerce needed a medium of exchange, colonies began experimenting with paper money long before the United States existed. Several colonies issued bills of credit, paper notes backed not by gold in a vault, but by future tax receipts. In theory, the colony printed notes, spent them into circulation, and later collected taxes to retire the notes. In practice, it was tempting for legislatures to print more than the economy could absorb, especially during wars or downturns. When too many notes chased the same goods, prices rose and the notes lost value. Yet for many colonists, bills of credit were not a luxury. They were the only way commerce could function at scale. Some colonies went even further by creating land banks, which were not banks in the modern deposit and loan sense, but institutions designed to issue paper money backed by land or mortgages. Massachusetts tried versions of this idea in the early 1700s. The pitch was attractive. Land was abundant, so why not turn it into money? But land is not liquid, and confidence could vanish quickly if people doubted whether those notes could be redeemed. These experiments revealed a recurring tension in American financial history. Paper can multiply economic activity, but only if people believe in it. British authorities watched colonial currency experiments with suspicion. From London's perspective, unstable paper money threatened creditors and complicated trade. Parliament responded with the Currency Acts of the 1700s, limiting the ability of colonies to issue paper notes and restricting their use for paying private debts. To colonists, these restrictions felt like a financial straitjacket. To British merchants and lenders, they were basic protection against repayment in devalued paper. The debate was not just technical, it was political. Who got to decide what counted as money in America, the colonies or Parliament? Long before independence, money and banking were already tied to questions of sovereignty. Then came the American Revolution, which turned financial improvisation into a matter of national survival. War is expensive, and the revolutionaries did not have reliable taxation or a developed financial system. The Continental Congress issued paper money, continental currency, to pay soldiers and suppliers. At first, it helped, but Congress lacked the power to tax effectively, and as the war dragged on, more notes were printed. Counterfeiting was widespread, confidence fell, and inflation surged. The phrase, "not worth a continental," entered the language as a bitter joke. This collapse taught a harsh lesson. Paper money without credible fiscal backing can unravel quickly, especially in wartime. At the same time, the revolution also revealed the importance of organized credit. Wealthy merchants and financiers, both in America and abroad, provided loans and supplies. States issued their own debt. The national government accumulated obligations it struggled to manage. By the war's end, the United States had independence, but also a tangled mess of debts, depreciated currency, and weak central authority under the Articles of Confederation. The new country could win battles, but could it build a stable economy? One early attempt to answer that question was the Bank of North America, chartered in 1781. Often described as the first bank in the United States, it was created with strong encouragement from Robert Morris, the superintendent of finance. The Bank of North America helped manage government funds, supported the war effort, and issued banknotes that were more credible than Continental paper because they were tied to a banking institution with capital and discipline. It was not a full solution to national finance, but it was a crucial demonstration. A bank could concentrate capital, support public credit, and create a more reliable circulating medium than ad hoc government printing. Yet the post-war period remained financially chaotic. Under the Articles of Confederation, the national government lacked steady revenue and struggled to pay debts. States pursued their own policies, often issuing paper money or passing stay laws that delayed debt collection. For farmers and debtors, easy money and delayed payments could feel like relief. For creditors and merchants, they looked like a threat to property rights and commercial trust. The result was economic friction that fed political unrest, including Shays' Rebellion in Massachusetts in 1786 to 1787, where financial distress and aggressive debt enforcement contributed to armed protest. To many leaders, the rebellion signaled that a weak financial structure could endanger social order. This unrest helped push the Constitutional Convention in 1787, where financial stability became a quiet but powerful motivation. The Constitution did not mention banks directly, but it reshaped the financial foundations of the nation. It gave Congress the power to tax, borrow money, regulate commerce, and coin money. It also prevented states from coining money or issuing bills of credit, attempting to end the fractured currency regime of the Confederation era. In other words, the Constitution created the capacity for a national financial system, even without spelling out every institution that system would include. But as soon as the new government began operating, a major question emerged: should the United States have a national bank? That debate would define the early republic. In 1790, Treasury Secretary Alexander Hamilton launched an ambitious plan to restore and expand public credit. His approach was bold. The federal government would assume state debts from the Revolutionary War, consolidate them into national obligations, and pay them reliably. This would tie creditors' interests to the success of the federal government, build trust in U.S. securities, and create a deep market for government debt. Hamilton believed that strong public credit would attract investment, stabilize the economy, and support national power. A national bank, in Hamilton's view, was a key tool to make that system work. The proposed Bank of the United States would hold government deposits, facilitate tax collection, make loans, and issue banknotes that could circulate widely as a trusted medium of exchange. Importantly, it would also help create a uniform financial infrastructure across states. In a vast, growing country, a bank with national reach could knit the economy together by standardizing payments and expanding credit. Opposition formed quickly. Thomas Jefferson and James Madison argued that the Constitution did not explicitly authorize Congress to create a bank. They feared that a national bank would concentrate financial power in a few cities, favor merchants over farmers, and invite corruption. They also worried that close ties between government and financiers might create an American version of the British system they had just fought against. The argument became one of the first great constitutional debates: strict construction versus implied powers. Hamilton defended the bank using the Constitution's necessary and proper clause, reasoning that if the government had the power to tax, borrow, and regulate commerce, it must also have the practical tools needed to carry out those powers. In 1791, Congress chartered the first Bank of the United States. For 20 years, it was partly private and partly public. Private investors owned most of the stock, but the federal government was a significant shareholder and partner. The bank helped stabilize the young nation's finances. Its notes were widely accepted, and its operations supported a more integrated market economy. It also restrained some of the more reckless practices of state banks by requiring repayment in hard currency when necessary, which could limit overissuance of paper. That discipline was valuable, but it also made the bank unpopular in regions that wanted easier credit.
To understand why these early banks mattered for growth, it helps to see what a bank actually did in an era before modern financial markets. Banks gathered idle capital and directed it toward productive use. They made short-term commercial loans that helped merchants move goods from ports to inland markets. They financed inventories, shipments, and sometimes early manufacturing. They provided a payment system, reducing the need to transport heavy coin over long distances. And by issuing banknotes, they increased the effective money supply, again, as long as the public trusted those notes and believed they could be redeemed. Credit was the engine behind roads, canals, ports, and expanding trade networks. Even when banks did not directly fund massive infrastructure, they supported the merchants, builders, and state governments that did. A growing nation needs more than land and labor. It needs coordination, liquidity, and confidence. Early banks supplied those intangibles. They turned future income into present investment, one of the basic mechanisms of economic growth. Still, early American banking was never free of conflict. State-chartered banks multiplied in the 1790s and early 1800s, responding to local demand for loans and a growing market economy. Some were cautious, others were speculative. Banknotes were not automatically uniform like modern dollars. A note's value depended on the reputation and distance of the issuing bank. In one town, a note might be accepted at full value. In another, it might be discounted. Newspapers and brokers published banknote tables, listing which notes were trusted and which were suspect. This system could expand commerce, but it could also confuse ordinary people and create opportunities for fraud. When the first bank's charter came up for renewal in 1811, politics and regional resentment helped defeat it. Many lawmakers argued that the bank was unnecessary or unconstitutional, and others wanted more space for state banks to operate without federal competition. The bank closed, and the timing proved unlucky. The War of 1812 began soon after, and once again the United States faced the challenge of financing war without a strong central financial institution. State banks expanded note issuance, specie payments were suspended in many places, and the currency system became even more uneven. The difficulties of war finance offered another lesson. National emergencies exposed the weaknesses of fragmented banking. These struggles led to the chartering of the Second Bank of the United States in 1816, a sign that even skeptics recognized the need for stronger financial coordination. But the deeper point for early U.S. history is this: banking was never just about money, it was about what kind of country the United States would become, commercial or agrarian, centralized or local, creditor-friendly or debtor-friendly, and how power would be divided between states and the federal government. By the time the Constitution had settled in as the nation's framework, the basic American pattern was in place. The country would grow through a mixture of private enterprise and public policy, with banks acting as essential intermediaries. Early banks helped the United States develop a national credit reputation, which mattered not only for domestic investment, but also for international trade and diplomacy. A nation that pays its debts can borrow again, attract capital, and weather shocks. A nation that cannot inspires higher interest rates, distrust, and instability. The birth of American banking from the colonies to the Constitution is therefore a story of experimentation under pressure. Colonies printed paper because they lacked coin. Revolutionaries issued currency because they lacked taxes. Early national leaders built banks because they needed credibility, coordination, and growth. Each stage produced controversy because money touches everything: wages, prices, debts, land, and political power. And each stage created tools that pushed the United States toward a larger, more connected economy. By the early 1800s, the United States was on a path toward rapid expansion: westward settlement, rising trade, and the beginnings of industrialization. None of that happened because of banks alone. But without early banking institutions, without organized credit, circulating banknotes, and the creation of public trust in national finance, America's growth would have been slower, more local, and more fragile. The banking debates of the founding era weren't side arguments. They were part of the blueprint for how a new nation would build prosperity out of uncertainty, and how the power to create and control money would shape the American future.